It was another quiet day on Wall Street with the S&P 500 advancing just 0.23% today. We saw about 60% of the components closing in the green, really being led higher by a couple of key areas like semiconductors and also a lot of the oil and gas companies. But the real excitement's happening after hours. Bed Bath & Beyond is getting absolutely annihilated, and so I spend part of tonight's video going through some of the things that I noticed on the options chain that you might find interesting as well. And then later on in tonight's video, I'm going to go through a trade application example where I wanted to focus on one of the most liquid communications companies out there and do what's known as an iron condor on it to try to take advantage of its range-bound activity. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's August 18th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. You'll also find which stocks are giving you overbought and oversold cluster signals at the bottom of those emails. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address in the logo in front of you. All right, let's go ahead and jump into today's trade activity. Let's get started here as always with our S&P 500 heat map. And as you can see, it looks like it was another kind of mixed session. It was another quiet day, one of those sleepy August days. We have quite a few of those, it seems, as a lot of folks are slowly getting back into their routines, coming back from summer vacations and all that kind of stuff. But as you can see, there was a little bit of a mixed bag here today. It was not overwhelming in one direction or another. Where I would say is that there are two areas in the green that do seem to provide a little bit more consistency, and that is technology here in the lower left-hand corner, and then energy towards the lower right-hand corner. Vast majority of those energy stocks were up. Looks like Phillips 66 was an exception to that, but otherwise pretty much all the other energy stocks were up here today in the S&P 500. Technology was a little bit of an oddball in that more of your mid-cap and smaller cap technology companies did better, but your two giants of the technology world, Microsoft and Apple, both finished down fractionally here today. But a lot of those semiconductors did quite well here today. NVIDIA leading the way up 2%, Broadcom up 3%, Qualcomm up 2%. We talked about that one a little bit today in my question and answer session. Also talked about Cisco a little bit, and Cisco, of course, known as a pretty good dividend growth stock over the years, had a nice little boost higher here today of about 5 or 6% off of their earnings announcement. That is the tech Cisco, not the food distribution Cisco, so I should clarify when I say something like that. But a pretty good day there for Cisco, and then also Keysight Technologies, which some of you have heard me talk about in my top-down trend trading class in the past. It had a nice response to earnings there as well, up about 6%. So all in all, it looks like technology was kind of pulling its weight here today, with the exception of the two giants there. When you look at a lot of the other sectors, it really is hit and miss. There's not a whole lot of consistency out there. I'd say healthcare probably looks a little bit more red than green, and that's maybe I would throw real estate in there as well. Now that I'm looking at real estate, it looks like there were only a handful of REITs that were up today. Otherwise, they were mostly down here today. But otherwise, kind of a coin flip when it comes to the various sectors that are out there. One of the worst performers today, speaking of dividend stocks, unfortunately, Walgreens just cannot get out of its own way. They got hit with another news story about a payment in regards to the opioid crisis, if I'm not mistaken. And so they were one of the worst performers on the market today, down 6%. Moderna, of course, famous for its development of a COVID vaccine, also struggled here today, down about 5%. Let's go ahead and now mosey along to our normal part of the platform and get a better sense as far as market breadth here today. You can see I've got the S&P 500 pulled up on the Visualize area of the Market Watch tab. And out of the 500 approximate stocks that trade on the S&P 500, 304 of them did close in the green here today. So that was good for about a 60% win rate there, and therefore a slight tilt towards the bulls here today, at least on an equal weighted philosophy. Let's go ahead and now take a look at some of our charts, and as you can see, not only was an equal weighted philosophy a little bit more bullish, but so was the market cap weighted when all was said and done. Despite some small sell-off in Apple and Microsoft, there was enough positivity in a lot of the other semiconductors and other names out there to push the S&P 500 higher by 0.23% today. So another very quiet performance there. In fact, I was thinking right before I was getting going here that, boy, it's been a long time since I've shown you guys this chart 6D, which I usually bring up if we have a move of over 1%. And it felt like for a while earlier this year, I was bringing it up pretty much every time I'd do the presentation. And then all of a sudden, here we are in August, and it feels like I'm never bringing it up anymore because we haven't had very many 1% moves. And it's possible that the rare days where we have them, I might not be the one doing the video. Maybe David is. So anyway, it's been a while. The last time we had a 1% down move on the S&P 500 was July 26th. And then prior to that, you'd have to go all the way back to July 11th. So really, since this market bottomed, at the beginning of July, we've just had two 1% down days on the S&P 500. That's quite rare, right? It's almost been a month since we had our last 1% down day. And as I just kind of glance at this middle area here in the middle of your screen, just eyeballing it, it looks to my eye like the only other time where that could have been the case in the last year was back here in that October to November time period, where it looks like it was also pretty quiet with none of those red bars coming down to touch the blue line. But otherwise, you've had tons and tons and tons of 1% sell-off days. By the way, that's also part of the reason why you guys haven't heard me discussing put sells all that often recently. We've done a few put spread selling, but we haven't done outright cash secured put sales like was the case earlier this year. Remember, earlier this year, that was my go-to strategy. I was doing it over and over and over again to the point where you guys probably felt like I was a bit of a broken record because we were having tons of 1% down days in the market. Volatility was high, premiums were juicy. Fast forward to where we're at right now, it's the exact opposite. So I'm kind of longing for one of those days once again. I guess I got to be careful for what I wish for, but I'm sure there'll be plenty in store later on down the road. But just kind of trying to stress the point here right now that this has been an incredibly calm time during the market compared to what we've witnessed for much of the last year. You can see that the VIX once again closed below 20 here today. It kind of settled out at about 19 here today. So remember, when the VIX is at 30, approaching 40, like it was earlier this year, that was when the market was quite nervous, buying protection within the options world. Today we see the exact opposite of that. Today it's as if the market has no concerns whatsoever, and people are just kind of getting back into the bullish swing of things. Let's go ahead and get back to our foregrid here, kind of wrap up our original discussion. So I was mentioning how the S&P 500 was up 0.23% today. And as you can imagine, a move like that is not going to do much to change the posture that was already established previous to that. So as most of you know, we've had a bullish posture for quite some time now. Going back to July 19th is the day when we got that posture switch from bearish to bullish. And we haven't changed a single day along the way, at least for the S&P 500. That would also be the case for the Dow Jones and for the Russell 2000. And the NASDAQ had that one little head fake day where it went back to a weekly bearish posture for one day, and then immediately the next day went back to bullish. So that one was a little bit of a head fake there. But otherwise, I would say that the market forecast posture setting mechanism has done a pretty good job keeping you on the right side of the market. It's not perfect. There is no perfect technical indicator out there, but in general, there's been a lot of people that have been fighting this move. And if you're somebody that generally is going to take your cues from the market forecast, you're probably thankful for that right now, considering the bullishness that has continued since basically the beginning of July or whenever that was. So anyway, more of the same here today. Not a big move, not something to get overly excited about, but just more of a continuation type of a move more than anything. So looking pretty good out there. We're now up about 9% over the last 3 months of this chart that we're looking at on the S&P 500. And again, strongly bullish posture and a green moving average telling us price is above a rising 30-day moving average. And just so I don't have to repeat myself so often, I will say that that is the case for all 4 of our indices, right? Strongly bullish intermediate postures on all 4 of our charts, and price trading above a rising 30-day moving average on all 4 of those charts. So they all kind of share that same commonality. And the other thing I would mention is that they all have quite an extensive air pocket or gap from where they're trading right now versus where the 30-day moving average is. I kind of alluded to this the other day, but in case you didn't catch that, one thing I wanted to share with the audience is, with us having a pretty aggressive rebound here in the market to the upside in the last month and a half, there are some people that are still fighting it. They still think in their heads, hey, this is just a head fake. We're going to go right back down. And by the way, this afternoon, there are some, there's going to be a massacre, perhaps, in the meme stocks as soon as tomorrow. I'll get to that here in just a second, but let me finish my thoughts here before I get to that. So, point being, we had a very nice rebound in the broad markets over the last month and a half. It's natural to expect some sort of a short-term give back. But because we have such a large gap above the 30-day moving average right now, my thought is if we get a pullback, which again is likely at some point, whether it happens next week or 2 weeks from now, who knows, but there will be some sort of a pullback eventually. But I've gone from thinking, hey, if there's a pullback, it's going to for sure lead to another really ugly set of trading moving forward, to now thinking we've got enough of an air pocket here where a typical pullback will still allow us to reestablish new support above that rising moving average. Whereas if you only gradually break through that moving average and then your air pocket is somewhat small, any natural give back or sell off would put you back below the moving average, where you would then start thinking again, hey, that moving average is going to act as resistance. You better be careful. So that's the nice thing about this rally that we've had in the last month and a half. It's been so robust, so strong, that when we do inevitably get a pullback, it doesn't have to necessarily mean that we've got some sort of disaster in the wings like we might have thought earlier this year. So everything is always moving, so you have to account for that possibility of being wrong, but I think it's important to always kind of set your expectations and trade according to them. And right now, that's kind of the mindset of this market. Now, you can see the Dow Jones was up barely today. It was up 0.06% today. You can see the NASDAQ was up 0.21% today. And then the Russell 2000 was our leader here today. It was up 0.68% today. Let's talk about the meme stocks here for just a moment. Normally, I don't want to get into this because they're kind of play toys for traders, right? And I don't really take them too seriously. But they are interesting to watch from the sidelines without a doubt, and they can have an impact. Speaking of the Russell 2000, some of its performance is driven by the meme stocks because some of them get so out of whack from a market cap perspective that they are the most influential members of the Russell 2000. So that was the case, I know, for a while with like GameStop and what have you. So it is possible that the Russell 2000 takes it on the chin tomorrow compared to these other large cap indices. And again, the story after hours here tonight is on Bed Bath & Beyond. So let me pull that up. For those of you that aren't aware, the ticker symbol is 3 B's and a Y. So don't get it confused with Best Buy, which is 2 B's and a Y. This is Bed Bath & Beyond. So BBBY. And look at what is happening right now. There is going to be an absolute massacre tomorrow for some retail traders. I hope none of you get caught up in that. Naturally, with a wide enough audience, perhaps some of you are trading this. And remember, if that is the case, stay strong. Remember that you can always live to fight another day. I like to remind folks that when I first started trading, 22, 23 years ago, whenever it was, the very first stock I bought was JDS Uniphase. And for those of you that know your market history, you'll know that that stock eventually got absolutely annihilated. It was kind of one of the poster children of the dot-com bubble. Yet I'm still here 23 years later and have learned a few lessons along the way. So that's my little pep talk for you. If you are caught up in this meme stock saga and you have a hard day tomorrow, just remember, give yourself a fighting chance. You can come back from whatever the market throws at you. But to put this into perspective, I know this might be hard for some of you that are watching on, let's say, a smartphone to see, but this stock closed at $18.55 today. Now, that was already down 20% in the normal session. It had touched a high earlier today of almost $21. Earlier this week, I think it might have been as recently as either yesterday or the day before, I think it got to 30. So let me just pull that up real quick because I don't want to give you the wrong information there. Let me pull up just chart 3A for right now and pull up Bed Bath & Beyond. Yeah, it touched 30 just yesterday. So, this market moves very quickly when you're dealing with these firecracker types of stocks. This was a company that was trading at about $4 or $5 about a month ago. That went all the way up to $30. And from what I understand with the saga, as I've listened to some folks on CNBC, there is some controversy around it as well, because a lot of what led to this massive eruption higher in share price was this thought that this fellow Ryan Cohen, who is one of the co-founders of Chewy, the dog food company, he's had some influence on the markets in recent years, especially with the meme stocks like GameStop and what have you. Well, anyway, there was a report the other day that suggested he was buying tons of call options, long-dated call options and what have you. And then it comes out that after that had an impact of the market, and this stock was like up 100% or whatever it was the other day, it turns out that those call options that everybody was getting whipped into a frenzy about were actually not recent trades or purchases. They were from a long time ago. And the media maybe got it wrong. I don't know. I don't know who's to blame in a situation like that. Maybe that's just how the filing works. I'm not an expert in that area. But the point is, today, the market got a wake-up call around that concept. And, somebody top-ticked that yesterday. Whoever it was, I feel bad for them, because whoever's holding that thing at $30 is going to have a nightmare in their hands as soon as tomorrow. So anyway, yesterday it hits $30 per share. Today, the market catches wind of that these were actually trades that were done a long time ago and should have had no positive impact on this stock earlier this week. So this stock was down 20% in the normal session today. Now, if you think that's bad, brace yourself. It's about to get a lot worse, because here's what's happening in the after-hours session. This stock is getting absolutely murdered. It closed the session, the normal session, at $18.55. It is currently trading in the after-hours session at $10.50. Yes, you heard that right. This stock is going to be down like 40% just in the after-hours session after being down 20% in the normal session. So imagine, again, somebody who bought this stock at $30 yesterday that wakes up tomorrow morning and sees it at $10. In 2 days, they lost 66% of their money. So I've heard this phrase out there before, and I've often wondered what sort of a situation it applies to. But the phrase is, play stupid games, win stupid prizes. And I've always wondered, well, what does that exactly mean? Now I think I get a sense as to where a phrase like that could apply, and it could very well apply to this situation right here. The other thing that goes through my head is tomorrow's options expiration day. And tomorrow is going to be a day that turns out to be an absolute bonanza for some people and an absolute day of despair for other people. Check this out. So when you look at this open interest column over here, I'm looking at the August contracts for Bed Bath & Beyond. These are the ones that expire tomorrow. That one over there means that tomorrow is the expiration day. So in other words, the time is almost completely wiped out of this. There's only 1 day left. These have been live for several months, but tomorrow they're going to wrap them up. And, you can see here that today there were 20,000 contracts traded in the $10 strike price puts, which is insane. This stock was trading at $18 in the normal session. Yet there were a lot of people trading in this, and that was just today's volume. Take a look at the open interest. The open interest was the highest of all these. The only other one that comes close to it is the $15 strike that had 20,200 in open interest. So that's kind of an interesting storyline as well. It almost gives you the impression like somebody knew something, right? And some of you have heard that concept of options market makers trying to pin the strike. And that might very well end up being what happens tomorrow. This thing might get pinned right to the $10 level because that's where you have the most open interest on this thing. And earlier today, if you would have told that to somebody with a straight face, they would have laughed you out of the building. Like they would look at you and say, so you think that as soon as tomorrow, this stock is going to drop 60% or 40% or whatever it is, right? And sure enough, that's exactly what's looking like it's going to play out. Now, obviously, there's a lot of time to go. We don't know if that's going to happen. Maybe the stock opens up at $15 tomorrow morning and the dust settles. Maybe it opens at $7. I don't know. But right now, it is very interesting to me that at this exact moment in time, this stock is trading at $10.66, and it's heading for that open interest, the biggest part of that open interest that you see right there. The other thing that kind of goes through my mind is, while I don't have any, horse in this race, I'm not long or short this, I have no exposure whatsoever to this particular company, but I do like to sometimes put my head into the mindset of those who are trading it. And, as I look at the bid-ask spreads of these strikes that are close to at the money here in the after-hours session, I do wonder what goes through the minds of people who are trading at the very end of the day today. And one thing that catches my eye is the $11 strike right here on the put side of the equation. You can see that the last traded price was 5 cents. But you can also see that the bid was 2 cents and the ask was 4 cents. So there was somebody out there, maybe it was one of you, who knows, but there was somebody out there that wanted to get out of their puts at 4 cents. You can tell that they were somewhat desperate to do that because they were willing to go under the last traded price of that put. And I can only imagine what a sigh of relief they are feeling right now that they didn't just go and hit market order on their trade. They had a limit order out there for 4 cents. And instead of just hitting a market order and getting filled at 2 cents, they decided, to heck with it. I'm just going to keep my trade. I'll get it taken care of tomorrow. Well, guess what? They're going to wake up tomorrow, and whoever's sitting there on the 4 cent ask on the $11 strike puts, that is going to be a win of all wins from a lottery ticket perspective. That particular trade is probably going to go up hundreds, if not thousands of percents, depending upon what we see right now. Now, of course, that all sounds fine and well, and we all wish we could do that. But the truth is, who amongst us would be able to predict that a stock would be down, 40, 50, 60% in just, an after-hours session type of activity? So some people are going to feel awfully good and awfully lucky tomorrow. Those who are the holders of put contracts, those who had been selling these put contracts are going to probably get run over tomorrow. And you guys will notice that when I do the idea of put selling with you, I practice the approach that I teach my students in my Monday afternoon Options for Long-Term Investors class, which is I try to concentrate on high-quality merchandise, the stocks that have long histories of raising dividends and blue-chip companies and what have you. You'll notice that Bed Bath & Beyond, of course, does not pay a dividend, so this is not a company that I would teach you to sell puts on, but there are people that are doing that out there. And tomorrow, they're going to learn why a lot of times people call that the idea of picking up nickels in front of a bulldozer, because they're going to get squashed by a bulldozer tomorrow. So anyway, I hope it's none of you. I hope you all are avoiding the chaos that is the meme stocks. If it is, like I said, keep your head up. You'll get back. It'll take a while and you'll feel awful, but you'll get back as long as you have that determination. And for those of you lucky few who might be the lucky holders of some puts that expire tomorrow, congratulations. You're going to have yourself a wonderful weekend. Go out there and buy a new car or something, right? It could be pretty spectacular. So keep your eye on the fireworks in the meme stock craze tomorrow, and let's see how that impacts something like the Russell 2000 as soon as tomorrow as well. All right, let's step away here for a second. pop on over to the internet. I always like to get a chance to say thank you to those of you that help support these free market outlook videos. And as you know, there are 4 different ways that you can click like for us on Twitter. Here's probably the easiest way for a lot of you. Just go to either David and I's Twitter feed and just look for the tweet that we have pinned to the top of our timeline. And 101 of you clicked like for me last time around, so we just barely got up and over that triple-digit area. So thank you especially to the last 2 people who clicked like, because otherwise this video would already be done. Remember, as long as we're up and over 100 likes, I'm happy to do a full-length video that includes a trade application example and 12 grid analysis. If we're under 100 likes, then I'll just plan on doing a 15-minute video only on the indices themselves and not give you the extra stuff, and just try to keep it a little bit more efficient there. So I let you guys decide collectively what you prefer out of those 2. So let's do some thank yous out there. I'd like to thank Ron and John and Sunita and AC and E-Mini and Bank and Maria, Trunk, Ed, Gerald, Prickly Trader, Da Dave, Norm, Ayakipa, Brian, Kirk, Jerry, Ann, Margie, GJ, Kenton, SW, Ken, Dave, Sudhir, we've got Serene, Pam, and others. I can't get through all of you, but I at least like to throw some shout outs to you out there to let you know that yes, we do pay attention, and we are very thankful for you. So thank you very much for getting the word out about Market Scholars and helping motivate us to do these videos that show up at your doorstep free of charge there, mostly every single trading day. Also, earlier today, of course, we had a busy day of teaching here at Market Scholars. I taught my question and answer session. So I got a question about reviewing an upcoming spinoff of 3M of their food safety division, and then a spinoff into one of the divisions of Neogen, and kind of reviewing that for one of our clients and trying to make some heads and tails out of it. Also got a question about Unum as a dividend growth investing candidate. Also got a question about kind of a high-level topic about how we as dividend growth investors who use DRIP could actually be far better off if the stocks that we purchase go absolutely nowhere for the first several years of our holding period, to then only erupt after that. Some of you saw my tweet the other day of the very interesting case study of the person, I think from Austria, that was a dwarf up until the age of 19, that did not surpass the height of 4 foot, but then between the ages of 19 and 21 had some sort of an issue with the pituitary gland and ended up being a giant that was over 7 foot. So it is the only case known of somebody being both a dwarf and a giant in their same lifetime, their only lifetime. So I kind of referred to that in this conversation about how when you are a dividend growth investor and you're in your accumulation phase, you actually want the stock to go nowhere or even down a little bit would be helpful if it eventually, of course, rebounds and quality rises to the top in the later years. We also had a question about ETFs, especially dividend ETFs, and how to think about those, and whether there's some pros or cons of dividend ETFs versus individual dividend stocks. I also got a question on Kroger and reviewing that with different straddle and some of the different strike prices out there from put selling perspective. And then I got a question about how to handle some of the more popular utilities that we've been trading in my trend trading class here this year, Exelon and Constellation. And so anyway, another great session there. If you are a premium member of Market Scholars and any of that content sounds interesting to you, feel free to check out the recordings on the Trading Rooms tab. And then earlier today, David taught his portfolio management with ETFs class. He always does a great job kind of trying to get a feel for what's happening from a macro perspective and then applying that to a portfolio of ETFs. So make sure you're checking out that content as well. And then tomorrow he'll be teaching his very popular technical analysis class, which is always a fun class for those of you that want to be taught directly from a market technician like David. So lots of good stuff out there if you're a premium member. If you're not, we'd invite you to sign up. And remember, we generally do just one big sale a year. This year was a little bit different because we had that kind of goofy date back in February where we had our once-in-a-lifetime 2-2-2-2-2 sale. So that was a one-off. But normally we just have one big sale a year, and that is in November during our Black Friday time period. So if you're thinking about upping your game, so to speak, getting more educated within the markets, then keep your eye out for those potential sales that will be heading out here in just a couple of months as well from the premium side of the equation here at Market Scholars. Also, let's have a chat about Factor Selector. Remember, this is a couple of days stale at this point, but can still give us an idea of what we're seeing within the marketplace. And I'm not going to really spend a lot of time on it this time because, as you can see, we didn't have a single change in terms of the rankings week over week. Every single one of them from 1 to 6 were the exact same 1 through 6 rankings last week. So we're in a little bit of a peculiar market that is kind of just status quo. There's not a big change that happened week over week. It's just the same themes really were continuing, with low size leading the way up at the top. And again, like I said, watch out for that tomorrow. Things could change there with the meme stock craze, but dividend yield as being more of a defensive characteristic, struggling at this moment in time compared to what they were doing earlier in the year when they were kind of the go-to area when there was a lot more chaos out there. All right, let's go ahead and get back on over now to the main part of the platform, and let's do some 12 grid analysis. Starting with chart 5A. This is your asset class 12 grid. And a reminder that the background colors of these 12 grids will tell you what the current posture is using the market forecast intermediate line. If the charts have a green background, that means the current posture is bullish. If they're pink backgrounds, then that means that they're bearish. And as you can see, most of these charts in front of us right now do have more of a green background, telling us there's more bullishness out there across most of these markets, with just a couple of examples of a little bit more bearishness out there. Since there's only two pink charts, let's talk about those first. It's foreign bonds here in the middle rung, and then gold on the bottom rung. And to be honest, I don't think either of those two are a disastrous scenario right now. They could turn into it for all I know, but right now, I actually wouldn't mind the idea in gold's case of saying, hey, if you're going to take a stab at gold to the long side, I don't actually mind the idea of doing it now, because we have that potential with gold where for months and months and months, remember we're only looking at 3 months here, but if you looked back even further, gold had been in a downtrend for quite some time. You finally got all these oversold cluster signals, which led to a reversion to the mean type of a rally. You went beyond the mean, in other words, beyond the 30-day moving average. You established a pretty good amount of space between price versus moving average. Now you're having that give back, which we all assume would happen, and now you see that it is met with a green moving average. Right back here, you also had gold go above the moving average on this candle and on this candle and on this candle. But you'll notice that that just produced a one-off yellow moving average. This is the first time where we got above the moving average, and we're now plotting a green moving average, which basically means the moving average is now rising and price is above it. So if you've been waiting patiently for a better entry in gold, this might be a time to take a stab at it. Let's just see how that might play out. Foreign bonds is a little bit different because here you can see that we've actually kind of breached it to the downside, and I know that because the tip of the moving average is yellow at this moment in time. So yesterday you were slightly above it and it was still green. Today you actually close a hair below that moving average, painting that moving average yellow. So there's a little bit more concern there that, hey, you're kind of breaking some support here. And you can see that earlier this week we had broken support on TLT as well. And of course the flip side of that is TNX, which is your treasury yield itself, is now back above its moving average. So if that trend holds, in other words, interest rates continue to drift higher or rise outright, then that will pressure bonds. So I'm not quite as enthusiastic about that one, but I think the gold idea is somewhat interesting here. For those of you that want to take a stab at that. The rest of our charts are all green. And I think the one that stands out to me the most right now of the green charts is actually the US dollar. Not necessarily because it was some sort of a eye-popping day. Yes, 0.77% is a big day for a big currency like the dollar, but we're not talking about going out and picking out what color of Lamborghini you want with that type of a move, right? It's a relatively modest move. But really what caught my eye with it is it passed the smell test, right? We were talking about that last week, how we were establishing more time below that moving average, which could set up the possibility of that moving average being used as resistance. Well, today I think we may have gotten our answer. And right now we're seeing that it doesn't look like it wants to use it as resistance. We had a healthy move well above that moving average. In fact, so much so, notice that the moving average was painted green here as well. So we have price above a rising moving average once again, and we also have a weekly bullish posture right now. And remember, that can change perhaps as soon as tomorrow. If we have another big day in the dollar tomorrow, remember the intermediate line would just need to get above 50 for this to be plotted with a dark green background color. And that can happen relatively quick. It could happen as soon as tomorrow or perhaps early next week. So all of a sudden, the dollar looks pretty strong again. And I'm not necessarily too excited about that. I personally find it a little bit easier to trade stocks in a weak dollar environment. So I hope this doesn't become an excuse or a reason or a catalyst to sell stocks moving forward. So we'll just have to play that by ear. But what I can tell you for right now is this has been a very aggressive rally out of the US dollar since kind of bottoming out here on August 11th, which was just a week ago. We've gone pretty much straight up over that time period. So that's a pretty nice move there, and we're now back in clicking kind of more in the bullish US dollar mode once again. Remember, that's part of the reason why gold has been selling off mostly every day in the last week, is because the dollar has been going up every day there. So that's one thing you'll have to consider as well. If you are going to take a stab at gold to the upside, you should probably have some sort of a thesis as to why the US dollar is not going to go higher. Because if the dollar does continue to go higher from this level, then all else being equal, gold will likely be pressured in that situation. Also be aware that when the dollar is up, typically you find foreign securities, paper assets, struggle on a comparative basis compared to US assets, and that's exactly what we saw play out today. I talked about foreign bonds already. I didn't specifically state it. I talked about the bearish posture, but you'll notice BNDX was down 0.22% today. Notice the two charts on either side of it. Long-term US Treasuries were up today. So were high-yield bonds. So in general, bonds were up today, but foreign bonds specifically were down, and that's probably due to the surging US dollar. And then if you did the same conversation on the stock market, notice up above, the US stock market was up 0.29% today, but look at what happened with foreign stock markets. Developed foreign stock markets were down 0.33%, and emerging foreign stock markets were down 0.57% today. So that's why some of you might not have a very direct interest in what's happening with the US dollar, but I hope that by going through this analysis as much as we do, you all recognize that the dollar does have sway over your portfolio, even if you're not trading it directly. It has indirect sway on the things that you are trading. So let's keep our eye on that kind of newly emergent dollar bullishness that we've seen in the last week, and see if that continues to pressure foreign stocks and foreign bonds that are out there on a comparative basis. All right, let's go ahead and now pop on over and take a look at some of our sector analysis. And this will be chart 5C for those of you that are premium market scholars following along at home with your own charting package. And as you can see here, we still have that clean sweep. I talked about that on Tuesday. It's still the case today. Not a huge surprise because, of course, markets have been behaving themselves in the last couple of days. So kind of status quo at this point. Now, there has been a few sectors that have kind of given back a little bit in the last couple of days, so maybe that would be helpful to review here. Communications has been down 2 days in a row. We've also seen discretionary down 2 days in a row, but let's be honest, it's kind of flat on discretionary. So I don't really want to throw them under the bus or anything like that. Healthcare has been a little bit more of a give back. That's 3 days in a row for healthcare to the downside. And then you also had 3 days in a row to the downside for real estate. So those are the ones, all else being equal, that probably have a greater chance of seeing their postures switch first, even though there is no guarantee around that either. It's just that you're trying to kind of think in advance, hey, if these charts do start to change back to bearish, which ones are we expecting? Well, those areas that are getting more wear and tear in the short term are the ones that have the greater probability of leading us into some of that bearishness there. The other areas, if you kind of turn that concept on its head and said, okay, well, what is outperforming the last couple of days? I would throw energy in there. Remember what I'd mentioned here a moment ago when we were looking at the heat map, where only Phillips 66 was down today. The other energy companies were all up. And so take a look at what that means for XLE on the whole. This one has actually broken out of some of this kind of more shorter term resistance area. You had a little bit of a double top there on XLE from July 29th to August 12th. That was a little bit of a double top there, and with today's move on energy, we broke up and through that. Now, obviously, we still have a lot of overhead resistance from this prior move back in June, but that's at least a good start, right? And this trend was being a little bit more called into question because it was kind of lagging a lot of these other sectors for a while. So I think this kind of puts them back in a little bit more of a bullish camp. You're not at new multi-month highs like you are with some of these other sectors, and even utilities is basically at all-time highs. So you're not that strong on energy right now. But at the same time, you're not just looking for every excuse to sell off, like it kind of felt like was the case here, at the end of June into early July. So there's a little bit of stability taking place there with energy. We'll see where it takes us. We actually still own this XLE, I think, in my top-down trend trading class. Every so often we buy ETFs in addition to common stocks, and we had bought it earlier in the year and did okay with it and then watched it completely unwind right here. But fortunately, we haven't been washed out of it quite yet, and we're kind of giving it a chance to kind of prove itself. And right now, I'm somewhat thankful that we've done that. So we'll see where it takes us, but I was impressed with the move out of energy today. The other thing I should mention is that it basically closed at its daily high, right? So that is a nice looking candle there as well. Not only did we break through it, but we closed at the high on the breakthrough of that mini double top that we had right there. And I think that's important as well, because remember, we've seen plenty of patterns in the past where you break through an important resistance area and then you have the retest, right? And sometimes you even fail on day one, where you break through it, you catch everybody on the wrong side of the trade, and then the market makers punish you and they close the trade back below the original breakout point. That's not what we had here today. You had a breakout and a continuation of that breakout on that mini double top pattern right there. And you basically close at the high of the day. So I think that was healthy trading there for a lot of those oil companies today. You'll notice that most of these other charts either closed in the red today or closed off of their high. So really it was only energy that did that. Staples got somewhat close to doing that, but even that has a little wick on it there at the top. So energy to me seemed like it had the most positive momentum here today, and it was the one that was up the most, up 2.69%. In terms of which sector did the worst today, it was healthcare, down 0.44% here today, but it still remains with a bullish intermediate posture at this time. So that's your sector breakdown. Let's go ahead and now talk about our trade application example. Now, I had mentioned that communications had been selling off the last couple of days, whereas the market has been holding in there a little bit better than that. And you can see that this communications has kind of been stabilizing and carving out some higher highs and higher lows here ever since this bottom back here in the middle of June. So I think what we've seen out of communications is reasonably healthy, but it's just simply not as robust as what we saw out of technology. Technology is just roaring higher, right? It's up 14% in the last 3 months. Communications is only up 1%. So it's not nearly as aggressively traded as what we're seeing there with technology. Maybe that's good or maybe that's bad. It's lagging on a relative basis On the flip side, I think there's a lot of people that are a little bit afraid to take on trades right now because so many of these charts are really extended. And one, I guess, positive element about being a relative laggard recently is that communications doesn't feel nearly as extended as what we're seeing with a lot of these other charts right now. So that kind of plays a role in my trade application example here tonight. So let me pull up chart 3A, and I'm going to pull up one of the most famous communication stocks, which these days goes by a different ticker symbol. This is the old Facebook, these days known as Meta Platforms, ticker symbol META. And you can see I've got two purple lines drawn on the chart here as well. Those purple lines represent the break-evens of the trade that I did here earlier today on Meta. What I did was what's known as selling an iron condor. Most of you are familiar with that technique, but some of you who are newer to the options world might not be. So just a brief understanding of the iron condor. When you're a seller of it, basically what you're doing is you're trying to determine where you think the stock won't go, right? And that's kind of a different concept than when you're more directional by nature. If you're trying to buy calls, you're basically saying, I need that stock to go up. If you're buying puts, you're saying, I need that stock to go down. If you kind of reverse that mindset and you use the drivers of a trade as those calls and those puts and you sell them instead of buy them, then what you're kind of saying is, I don't really know where the stock is going to go, but here's where I don't want it to go. And I don't want it to go up tremendously, and I don't want it to go down tremendously. And if it just kind of meanders nowhere, I'll be happy with that. So it's kind of a unique trade from that perspective, because I think a lot of newer investors and traders especially think that they really have to nail the timing of their trade in order to make money. And that's just simply not true. There are plenty of option strategies out there that you can make money on where you can be a terrible market timer. And you could have very little ability or skill whatsoever to predict where a stock is going to go, and you can still end up making money on the trade. So in this particular case, I did what was known as selling an iron condor, which means I'm selling a bear call spread on the top side and at the same time selling a bull put spread on the bottom side and creating break evens in two different places of the chart, and basically kind of putting myself into this middle territory in order to find success with the trade. I did the September contracts here today, and so I'm getting a little bit closer to moving along to the October contracts, but at least for this week, we're going to stick with the Septembers. And what the strikes that I selected were the 155 put to sell, the 150s to buy on the bottom side, and on the top side it was the 195 calls to sell and the 200 calls to buy. Now because that involves 4 different strikes, it's important for you also to know that one of the characteristics of selling an iron condor is that you should demand excellent liquidity out of the underlying security. Sometimes you guys will see that I will be happy to sell single-legged strategies like selling a put on a dividend stock where I don't really care about the liquidity all that much, to be quite frank. Because in a case like that, oftentimes we're selling a put with the intention of buying it if it closes in the money. So I don't really need the liquidity to get back out of the trade. Well, that's not the case here with these iron condors. I have no intention of letting this close in the money. And so I may very well need the liquidity on the way out. And it's important for me to have the liquidity on the way in as well, because if you do not have tight bid-ask spreads, you're going to get eaten alive in your slippage in your trade. And the reason for that is you're not just doing one contract, you're doing 4 different contracts. And if you have illiquidity on one contract, chances are you're probably going to have illiquidity on the other 3 as well. So I thought that was kind of an important lesson to remind folks of here as well, because I don't do a whole lot of iron condors. David does a lot more of them. But for those of you that maybe watch my videos more than his, which I hope is not a lot of you, I hope most of you are watching both of our videos. But in case there are a handful of you that mostly watch my videos, I just want to make sure I'm stressing that educational point, that if you are somebody who plans on doing a lot of iron condors in the future, make sure you get in the habit of ensuring that you're doing them on the most liquid companies out there. And that is one of the nice things about Facebook/Meta. They are an incredibly liquid company, one of the largest companies on the planet, and people love to trade their options. And so you can get very efficient pricing. Doesn't mean that you have any sort of guarantees to make money or anything like that, but you don't have at least that roadblock immediately staring yourself in the face with a trade of a perfect setup but terrible liquidity that might end up being what does you in, so to speak. So anyway, this is one that caught my eye because it is not explosive to the upside, right? There are plenty of stocks that are breaking out to new monthly highs. Heck, some stocks like Pepsi are breaking out to all-time highs right now. This is one that's not doing that. This is one that's kind of been stuck in a rut. But it's enough off of the bottom where I felt a little bit more comfortable saying, hey, we're well off of the low of 154.25, where I'm not necessarily nervous at this moment in time that it's going to break down again. Like over here, I probably would have been right before earnings with this candle. I'd be thinking to myself, okay, watch out below. But as you can see, a few days after earnings were released, this thing kind of stabilized at about the same areas back here, kind of putting in a bit of a double bottom and then moving its way higher, and kind of more recently failing at around the same level that it failed back here. So anyway, these purple lines represent my break even. For those of you that are new, what I want out of this trade is for Meta to stay between those two purple lines between now and the middle of September, so about a month from right now. And if the stock does basically nothing but what it's been doing for the last 2 months, for the next month in front of us, I'll be happy because I'll make money on this trade. On the other hand, if it has some sort of an enormous breakout to the upside or some sort of a terrible, disastrous breakdown to the downside, then my trade will get in trouble. But the good news about that is an iron condor is a defined risk trade. The reason we also buy puts and buy calls as part of this and not just selling calls and puts is because the bought calls and puts can act as a hedge of sorts. Now, you'll still end up losing money, but you won't lose incremental amounts more money the further it falls or the further it goes up beyond your break even. So that's kind of the nice thing where you can feel maybe a little bit more comfortable with a trade like this as well. And I was able to get more than a 30% return on risk for this, which is what we oftentimes shoot for. So anyway, that's what I had for you, kind of trying to take advantage of the sideways range-bound trading of a highly liquid security like Meta and doing an iron condor on it. Hope you got value out of that conversation and the analysis prior to it. If you did, I ask one simple request, and that is just click like for me there on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do the video again on Tuesday, I'll be happy to give you another full-length video, including a trade application example like the one I just showed you. If we're below 100 likes, then I'll just plan on doing a quick hitter 15-minute video of just the indices themselves. So I'll let you guys collectively decide what you prefer out of me. But I do hope you all have a wonderful weekend. I think I'm going to get a little camping in with my son. Hopefully enjoy some nice weather before the summer goes away. And I hope whatever you guys end up doing on your end, it's an enjoyable experience for you, and you come back to the markets next week refreshed. Remember, David should be back with you tomorrow night as well. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.